Hello everyone, it's your boy D at Dahkay.fx. Today we'll be continuing with our mentorship where we end the tool. As you can see that I'm inside the node right now, we'll be talking about the introduction to Forex as the topic we are still on, and all the basics and tools used in Forex trading. So today we will be introduced to the chart, so let's get into the notes. So this is all about how to start trading. As I told you guys that today we will be introduced into the chart. So the first two things you need to know in Forex before you can start trading are understanding trading terms and developing trading strategy. So those two things are the most important things to do in Forex before we can start trading. So let's firstly begin with trading terms. So under trading terms we have buy and sell, demand and supply, buy and sell limit, buy and sell stop orders, and take profit and stop losses. So we will get into into details, and you'll understand every single term here. So firstly, let's start with buying and selling. What is buying and selling? So buying and selling is still more like you go into the market or supermarket to buy something, like any good of your choice or anything that you need, and selling is more like you as a person selling your goods or stock that you have. So that's the same thing as what we will do in Forex trading. So Forex is speculating on the upward and downward price movements of currency pairs. As you guys remember that we talked about currency pair on the previous video. So right now everyone knows what a currency pair is. So if you are new to the channel, please go to watch the previous videos so that you can follow and so that you can be on the same lane with us. So as I was saying, Forex is speculating on the upward and downward price movement of currency pair with the hopes of making profit. So here we sell or buy with the hopes of making profits either way. So all Forex trading involves buying of one currency and selling another, which is why it is quoted in pairs. You sell one currency or buying one currency. So as you guys remember, we have what we call a base currency and a quote currency. So let's get to know how or when to buy or how or when to sell. So you will buy the pair if you expect the base currency to strengthen against the quote currency. So for instance, we have USD ZAR. So as you guys remember, USD is our base currency and ZAR is our quote currency. So if you expect USD to strengthen, then in that case you will buy, and if you expect ZAR to be stronger than USD, in that way you will sell. So let's get to understand this, guys. Like if we can look on the below picture, we can see that we have our demand and buy here. Like don't mind that demand. We will talk about it on the next step. Like we'll talk about it immediately after this buy and sell. So we'll have a buy, so we need that's whereby the market or the price is anticipated to go up. So in forex we buy low. You all get it? If you anticipate the price or the market to go up, in that way you will buy. If you anticipate the market to go down, in that way you will sell. In forex we sell high, as you can see. So on the picture above, you can see that when the XAU is stronger than USD, the price goes up. In this case, whereby the XAU being gold is stronger than USD, in that way, like gold, we buy gold when it's stronger than USD, gold being our base currency. So, and on the other hand, if USD is stronger than gold, USD as our code currency is stronger than gold. In that way we will sell, because we sell high and we buy low. So let's get on to another term. So we have what you call demand and supply. The supply and demand is still the same supply that you know if you are a business person. Like if your ovens or business, you will have a supplier who will supply you with stock, and the consumers who will demand what you are selling. So that's the same thing even here in forex. So supply and demand rules state that if the supply of the commodity is high and the demand is low, this generates the excess which drives the price down. Let me elaborate this even more. So if you're a person and you are selling some goods at your store, so if you can see that the rate at which those goods get into your business is more higher than the rate at which people are buying those goods, in that way you will decrease the price so that those goods can be bought even more. That's what we call selling, because in that way when the price is going down, we sell, right? So if you notice that the supply rate is higher than the demand rate, in that way the price will go down, and in that way we will sell and make profit, because we'll be avoiding our goods to be rotten, as the suppliers will keep supplying but buyers are not buying. So that's the same thing as in forex. So we also have the case whereby the demand is higher than the supply. Back to the example that we have, if you notice that the people are buying your stock more than the rate at which suppliers are supplying you with stock, in that case you will increase price, because you noticed that people are buying your stock more. Like your stock is the most wanted, in short. Yes, if you see that what you are selling is bought by most of people, in that way the price will go up, and once the price goes up, in the market we buy, in forex we buy when the market goes up, like if you remember on the previous examples under sell and buying. So let's go into the orders. So guys, we also have what we call buy and sell limit. Here, firstly, let's talk about buy limit. Buy limit is an order placed at the demand zone or where the market is likely to buy, or where the price is likely to go up. This helps to open a trade automatically yearly, mostly when you are not around. So guys, as we can see on this below picture, we can see that let's consider that green line as our support. So once we can see that the market or the price is going to hit that support and you'll be not there at that time, you set your buy limit at that point. So in that way, when the market reaches that buy limit of yours, it will enter a buy trade. So let me show you how. So for example, if you have seen that the market on previous movements was returning at this level, so you can see that it's on its way down to this level. So you will set your buy limit at this point, at this support. This is what we call a support. So in that case, the market will go down as predicted, and once it hits this buy limit of yours, it will enter a buy trade here. So in that way, if the market goes up, you'll be already in and making profits. So buy limit helps you to enter the trades when you are not there. So sell limit is the opposite of buy limit. So if you have seen that the market on previous movements was selling when it reaches that point, and we can see that the market is on its way to that point, so you'll enter your sell limit above here. You'll enter your sell limit at this resistance here, so that when the market hits that point or that zone, you'll be able to enter even if you are not there. This is more like ordering, guys. So if the market goes down, you'll be already in with your sell trade here. So that's what we call limits. Let's also go to the others. So a stop order, buy and sell stop order. Buy stop order is the opposite of stop order. So let's talk about buy stop. So a buy stop order is placed above the market or the price. This enables you to enter when the market is already going at that direction, not before the market goes that direction. This is more like a confirmation. When you are not sure about your trade, you just enter that stop order. So for example, if the market is going up and you see that, okay, you are not sure whether the market when it reaches this level will go up or down. So excuse me, let's say the market was still going down, so you were not sure whether the market when reaches this level will go down or up. So you just place your buy order here just in case the market is going up, and your sell stop order here just in case the market goes up. So this will help you to enter a buy when the market hits this order of yours and goes up. And the same thing if the market is going downwards, like from here, and it goes downwards. In that way, once it hits your order, you'll be in and the market will go down and you'll make profits. So this is one of the strategy used by most traders during the big events, because big events are not easily predictable. Usually the CPI, because CPI is very fast, so this strategy is used only during the big event. So I think you guys understood what we call a stop order and buy stop order and a sell stop order. So again guys, we have what we call stop loss and take profit. So stop loss, as the name says guys, it stops you from losing, or it stops the losses, and take profits takes the profits. So these are two types of orders placed to secure the account together with the certain trades. As their name says, stop loss is used to limit risk by automatically closing trades once the price reaches that specific level of loss, just in case the market do not go according to the predicted direction. Also, take profit, as the name says, it is a type of a pending order placed to close profitable trades in order to secure our profit once the market reaches a specified price. So for example here guys, if you enter a trade here, like you see that okay, the market was still going up, and then you see that it's now starting to go down, and you enter a trade here. So your stop loss will be above this trade, just in case the market returns here and goes back up, and your take profit will be on the direction of your current trade. This is the zone whereby you want your profits to be closed. So in this case, if the market decides to go up against you, once it reaches this level, your trades will automatically close to secure your account from blowing as the market goes up. Also, if the market decides to go down according to your prediction, and once it hits this level, the profits that you will be running in your account will be closed and secured into your account. For example, if you made about let's say let's say if the running profits here were $100, yes, $100, sorry, excuse my mouse. So this $100 will be kept into your account once the market reaches this take profit of yours. In that way, your account will be saved from losing the profits that you have once the market returns and goes against you. So once it reaches this level, your account, your profits will be saved. So same as the stop loss, guys, you can put the stop loss on the profit side. Like that's what the swing traders do. So for example, if you have entered your trade here, your sell trade, and then you see that the market is going down according to your analysis, you can adjust your stop loss and put it here on the profit side, like here, so that you can secure the profits that you have already. And in that way, it will be guaranteed that you're gonna exceed the market with profits. Because if the market decides to return here and goes against you, once it hits this stop loss of yours, you'll be in profits, because you'll be having these profits here, these profits around this level. And once the market decides to go down, you'll be having the profits at this range. And in that case, once the market hits this take profit of yours, you'll also be on the safe side. So if you watch this video until this far, please give it the thumbs up, subscribe, and share with your friends, because it might reach where needed. Let's meet again on the next video. Thank you very much.